All right, traders, welcome to a brand new week. Hope everybody had a fantastic break over the Easter long weekend and hope everybody is ready to get back into the charts after the break. I mean, it's been a crazy couple of weeks over the last 2 weeks. Before we get into the week ahead, let's just quickly take a look at where we are trading across major asset classes. Look, for the most part, the sell the US theme that we've been seeing developing over the course of the last, let's just call it 2.5 weeks, that same theme has pretty much still stayed intact over the course of the last couple of trading days. If you take a look at the dollar index, for example, just earlier in today's session, we had that gap at the open, and just earlier today, we traded as low as 97.94. Now, that is, if my memory serves me right, that's March or April 2022 levels. Let's just quickly zoom out here. Yeah, that is March, April 2022 levels. I mean, just a massive amount of downside, 11% from the highs to the lows for the year so far. Just a massive downside. That same theme is basically still intact. Now, even though the bond market has calmed down a little bit from a couple of weeks ago, we can still see things like T-note futures still under pressure here. We haven't been able to see a lift back to the highs that we were trading at for T-notes a couple of weeks ago. And even though, to be fair, we have seen equities put in a very decent pop to the upside, we're still down massively on the year. If we just quickly take a measurement from yearly highs to where we're trading, we're still down 15% on the S&P. And you take a look at what happened last week. We tried another attempt to push up, and then the markets just smashed it right back down. There's still a lot of uncertainty right now, and market participants don't know how to price the risks that are involved right now. We've got a sell the US theme, which is something that the markets aren't used to, right? For the better part of the last decade, it's been all about buying everything US, right? Now the markets are saying, no, sell everything US. This has been a big shift, and the markets haven't been able to really adapt to this, which obviously leaves a lot of uncertainty in the wake of things, and that means we want to be a little bit careful. I mean, take a look at correlations. Correlations have broken down in so many different asset classes. If you take the most obvious one, would be looking at the US dollar and US yields. Taking a look at the dollar index here in white and US 10-year yields in pink. Normally we see these things correlated, right? Normally there's a positive correlation between these two. But take a look at this huge divergence we've been seeing developing over the course of the last week and a half. And you can see the size of this breakdown. If you look at, this is looking at the very short term. But to put this move into perspective for you guys, take a look at this chart. This chart shows us the 1-year rolling correlation, looking at returns on the daily level between the dollar index and US 10-year yields. Look at this huge breakdown that we've had in that correlation. These two things are normally very correlated with each other. It's not the case right now. And when these things happen, you need to pay attention. You need to be a little bit more careful, right? That is, we've seen volatility blow out across major asset classes. They have come down though, which we'll touch on in a second. The bottom line is there's still a lot of uncertainty, and that same theme that we've been seeing playing out for the last, let's just call it week and a half, is still very much intact. That also means, when it comes to, it's not just correlations, but when it comes to things like positioning, we want to be very careful with positioning information, because if you take a look at this table, right, this is showing you that from a currency point of view, the yen is still massively stretched on the long side alongside the euro, and the dollar is still very stretched on the short side. And if you take a look at what this means on the chart level, going back as far as I've been involved in markets, I have not seen the markets this long the Japanese yen ever from a positioning point of view. This is a massive stretched position. Now, normally, when I see a chart like this, the first thing that I start looking for is potential catalysts that could see these players that are so long the yen, what could disappoint them, right? What could see these guys dump those positions, forcing a little bit of a squeeze in the markets? But the thing that we want to be cautious of is that when we have these big things happening in major asset classes like the dollar pushing lower, bonds pushing lower, equities under pressure, when there's all of this uncertainty going on from a policy point of view, we want to be careful of looking at normal data sets like this the same way. We can't look at it the same way because yes, the data still matters, but it doesn't matter as much as it would in a normal environment, right? If this were to happen, if I were to see this chart 2 months ago, it would have been a completely different story. Right now, we want to be a little bit careful in terms of looking for fading opportunities and stuff like this, just because you can get run over very quickly. Momentum takes over after a while, and these moves that's been big, they can get even bigger. Take a look at euro dollar. Just a week and a half ago, there were so many participants on the institutional side still looking for the euro to weaken. And now it seems like everybody is on the different side, on the other side of the bandwagon, right? A couple of weeks ago, you still had some institutional players saying, no, we're still holding on to our bearish euro, a bullish dollar view. Now it seems like everybody has jumped ship, right? Like, oh, geez, okay, no, bullish euro, bearish dollar. These things always gets me a little bit cautious. Everybody that was bullish the dollar 2 months ago suddenly is now bearish the dollar. Everybody that was bearish the euro suddenly now bullish. That doesn't mean I want to fade these moves. It just means be careful because they were wrong 2 months ago. They could be wrong again. So just, take these things with a pinch of salt. The other thing that I wanted to quickly, touch on is implied volatility. We talked about this. And even though we've obviously seen big moves in implied vol across the board, looking at bond market volatility top left, we have FX volatility looking at the dollar index on the top right. Bottom left, we've got oil volatility and, bottom left, oil volatility. Bottom right, we've got the VIX. Even though we saw huge breakout moves to the upside in implied volatility, they have come down across the board. What does this mean for us practically as traders? It means that those ranges that we've been looking for, where we've been looking for slightly wider stops, wider targets, as long as volatility continues to come down, it allows short-term traders to tighten those stops a little bit, looking for shorter-term targets again. So that is just something worth keeping in mind. Even though there's still a lot of uncertainty, still a lot of stress, things have definitely looked they've looked worse, right, from 2 weeks ago. So things are starting to look a little bit better. Now, when we are faced in these types of, weird situation where things are moving, correlations are breaking down, positioning data doesn't matter as much, where do you find an edge? Because even when, just look at things like economic data, it hasn't really delivered the same type of directional volatility that we are used to in a normal environment, right? Normally, when you have very specific deviations that gets triggered in key data sets, normally you see a very predictable reaction in across major asset classes. We haven't seen that over the last 2 weeks. So when you have these things happening, how do you approach the markets? It's going to be different for everybody, but what I prefer to do in these environments is I prefer to look for those extremes and fade those extremes where I think the odds are in my favor. A very good example of this is what happened to euro sterling last week. This was a very simple trade, but it really explains what we're looking at here. So what was the trigger for this move to the downside, right? For this trade that we took to the downside last week. What we were looking at is things that doesn't require us to have a crystal ball when it comes to policy, right? There's so much uncertainty right now about both monetary and fiscal policy. It's impossible for me to know what's going to be tweeted next, right? Who's going to be shouted at next. It's difficult to trade that way. What I prefer to do in these environments is look at those massive extremes, and I'll look at the data in a second. Look at those massive extremes and then look for opportunities where I think there's a high probability to fade those moves. So again, euro sterling, very good example last week. Traded this down from 86.70 down towards that support area around the 85.20. Now, the first thing that caught my eye on this was obviously just the massive amount of upside that we've had in the pair in a very short space of time. But then some further digging showed us a couple of interesting things, right? So what we're looking at here in these charts is a bunch of different market measures that we look at from a fundamental point of view. This will be inflation differentials, it'll be growth differentials, yield differentials, a bunch of different things that normally drives or impacts FX markets. Now you can see here, looking back on the 14th, which is the trigger for that trade, we had a huge break to the upside in the euro sterling pair, but at the same time we had all of these different market measures showing us downside risk for the pair. That's the first thing that piqued my interest, saying, okay, we know the markets have gone a little bit extreme in terms of price action. Is there fundamental backing to look for a possible move to fade that extreme? This was the first check mark, saying that yes, across the board, you've got many different correlated measures showing you there's downside risk. Now, again, you want to be careful because correlations have been breaking down. But when it comes to these assets, which isn't the dollar, which isn't looking at the bond market, you've got a slightly better chance there of fading those extremes. The other thing, and obviously, here's how the move played out afterwards. We had the move rolling over, or the pair rolling over, and you've seen that basically, you've seen the pair following suit with what the other, with what the downside risks was showing us. Now, in terms of the second thing that we were looking at is volatility, right? We looked at volatility across the board a couple of seconds ago, looking at how we've seen it across bonds, across FX, across commodities, as well as equities coming down. Now, again, you're looking for those extremes to fade. Look at the extreme level of implied volatility that we saw for the euro pound, going back to the trigger of the trade, which was on the 14th. Massive amount of upside. We haven't seen this amount of uncertainty priced into this pair in a very, very long time. So that was, again, another trigger. We had a bunch of other correlated measures showing us downside risk. Then we look at volatility, and we were just looking for a little bit of a move lower, a little bit of a mean reversion in vol, a fade of the extreme, to then give us an opportunity to short the pair. So the reason why I'm showing you this example is that things are very, very hairy right now. There's a lot of uncertainty. The normal way that I, as a fundamental trader, look at the markets, you have to adapt. You have to be able to look at things and say, okay, where can I find an edge without having to have a crystal ball, without playing the same themes that I'm uncomfortable playing right now, like the sell everything US theme? Where else can you find an edge? And this is a good example of finding things where you don't have to be a rocket scientist to do this. You just have to look at those extremes, find the extreme, and see whether there's enough probability for you to fade it and potentially turn a profit from it. So that's just something worth keeping in mind. Again, you want to be careful of these things because correlations have been breaking down, but that's a good example of just a slightly different way of approaching the markets in a crazy environment like the one we are in right now. So getting to the week ahead then, what do we need to watch out for? The first thing we need to watch out for is we've got a massive amount of central bank speakers crossing the wires this week. A lot of FOMC and a lot of Bank of England people. Look, right now it's a very difficult spot for central bankers. I'm not expecting them to say anything new because they don't really have anything new to say. There's going to be a lot of talk about the uncertainty that's currently developing. The one thing that I will be looking out for, though, is obviously we've had a lot of negative talk coming out from President Trump towards Fed Chair Powell. If there's any solid and concrete developments from the Trump administration to potentially kick Powell out of his seat, if that's even possible, that could be a very negative catalyst for the markets to focus on. I would expect further downside for the dollar, further downside for equities if we were to see that happen, because that's just going to open up a whole new can of worms, a lot of uncertainty for the market. So watch out from a central bank point of view for any potential developments on the Trump versus Powell saga at the moment. So in terms of actual data, the main highlight for this week, not very exciting from a data point of view holistically, but the one we do have some excitement for will be the flash PMI data coming out for France, for Germany, for the UK, as well as for the US, and that's on Wednesday. This data will be particularly interesting, guys, because this will be the first real test of what the Liberation Day tariffs did to business sentiment. Remember, when you look at flash PMI data, any type of PMI, it basically tells you how are businesses perceiving their environment, right? How are they looking at new orders? How are they looking at prices paid? How are they looking at business activity? They've got a whole survey that they go through, and these measures are great because it gives you a snapshot of sentiment. And this is what the markets will be looking at, right? What type of impact did the initial April Liberation Day tariff, what impact did that have on sentiment? If we were to see some seriously bad numbers coming out of these prints, then obviously that could lead to some short-term weakness for those relevant currencies. So for example, if the French and the German data should come in massively below the market's minimum expectations, we could expect a little bit of short-term weakness for the euro. Same story for the pound, same story for the US. When it comes to trading this though, we want to be a little bit careful, because if you take a look at something like the euro dollar, for example, the way that I would normally trade a flash PMI is if it's a massive miss across the board, I would look for some short-term downside in the euro dollar. But because the markets are so anti-dollar right now, it might be worth considering looking at other type of alternatives as opposed to trading the euro dollar, right? Because the risk that you have is that any type of dip you get in the euro dollar might just be snatched up by the buyers and pushing it back up. So it might be worth looking at, again, those differentials like we did with the euro pound a couple of moments ago, looking at those types of pairs where you think there's already some downside risks showing up, and then looking at weakness in the data to potentially trade in that direction, right? So whether that means euro sterling to the downside or something similar, that is worth looking at in the week ahead for the flash PMI data. But it's also important here to understand that things have changed between what happened at the start of April and just a week ago, right? At the start of April, we heard of this massive amount of tariffs that's going to be announced across the globe, or on countries across the globe. And we know obviously from a week and a half ago that we've had the 90-day pause. So any type of very bad sentiment or data that we get from this, the markets might be able to even look through that and saying, okay, well, this is probably still due to what the markets thought tariffs would be. That numbers might be much lower over the next, or will be much lower over the next 3 months, and it might actually go away if we get deals being announced over the next couple of weeks. So we just want to be a little bit cautious here of the data. It's going to be the main highlight for the markets, and I would still expect some short-term reactions coming out of this, but we want to be careful of how we look to trade it, because the markets might be able to look through this a little bit easier than usual. The other data point that I think could be interesting here is looking at the Tokyo core CPI data coming up on, I believe that will be Thursday evening, Friday morning. The reason why this data will be interesting for us, guys, is that if we take a quick look at the Tokyo CPI data, the reason why this data point matters in the first place is because it's got a very close correlation normally to the national CPI number, right? So if you take a look at this chart, you can see a very close correlation between the Tokyo number in orange and the national figure in blue. So if we were to get a massive upside or downside surprise in the Tokyo number, that's going to impact how the markets view the national number, and that's obviously going to impact how the markets are currently viewing Bank of Japan interest rate expectations. So the preference for a trade like that is if we were to get some good news this week on the tariff front, and that leads to a little bit of profit taking in yen longs, because we know the yen is massively stretched on the long side. If we were to get a massive miss in the CPI data, that would arguably be the better way to look to trade something like the yen out of the CPI data. But again, we want to be careful of the data because it's just not going to be, at least from a positioning point of view, just not as important as a normal market environment. The other one that we can look at is obviously the the final University Michigan data for sentiment. Consumer sentiment has just been absolutely smashed over the course of the last few weeks now, as you guys know. Huge amount of downside. If this gets revised even lower, that could lead to a little bit of short-term weakness for the dollar as well as equities. And the other one we need to watch on that front is obviously consumer inflation expectations. Huge moves there in the 1 year and the 5 year ones. We're talking about 3 and 4 decade highs for these ones, right? So That's going to be in focus for the market as well. It's the final number, it's not the preliminary one, but big revisions there could also get some attention from the markets. The other thing that I think could be interesting this week, which isn't something that we normally focus on, it tends to pivot from important to not important, is bond auctions coming out of the US. We've got the 2-year note auction coming up tomorrow. Then we've got let me just see when we have the 5-year coming up on Wednesday, and I believe we've got the 7. Where's the 7? Here we go. 7 coming up on Thursday. 2-year, 5-year, 7-year note. If we were to get massive low bid to cover ratios in these auctions, showing a lack of demand for US bonds, that's something that could lead to some further downside for T-notes, further upside for yields, further downside for the US dollar. If however these bond auctions comes out and they show a very strong demand for bonds, basically a higher bid to cover ratio, that could be something that yields or that the bond market could like, seeing a little bit of downside yields, maybe a little bit of upside for the US dollar. So that's also something worth flagging as a potential mover this week, a little bit more than we would have focused on just 2 weeks ago. The other thing we need to just be aware of this week is obviously earnings season continues. This week we've got a couple of big names coming up, like Tesla, like Boeing, like Google, Intel, etc. When it comes to these names, the ones that we'll be focusing on the most, as always, is the ones that has the biggest weighting in the equity indexes, right? So for example, Tesla, it's got a 3% weighting in the NASDAQ. Boeing's got a 3% weighting in the Dow Jones. You've got IBM, which has got a 4 or 5% weighting in the Dow. And then obviously Google, Alphabet, almost a 4% weighting in the S&P, over a 7% weighting in the NASDAQ. These names really matters. What the markets will be focusing on, I think, in this earnings season, we spoke about this last week as well, it's not just whether we beat or miss estimates. Those things will be important, right? Looking at EPS, looking at revenues, but more importantly, the guidance will matter a lot in this earnings season. What does companies have to say about the tariff situation, right? How is it impacting their hiring plans, right? Are they planning on laying off people? That will be a negative one if that's the case when it comes to equities, when it comes to the dollar. Are they planning on laying off people? Are they planning on stalling investment, right? So investment, hiring plans, how it's impacting pricing pressures, all of those things will be key focus points for this earnings season. Bad news, bad for equities. Good news, good for equities, generally speaking. So just keep that in mind as a possible risk for the markets as well. So not a whole lot to get excited about this week, but there's a couple of things we need to just pay attention to. For now, like I said, this is a very, very tricky environment that we're trading in right now. You're either going to love this environment or you're going to absolutely hate it. Just make lemonade out of lemons, basically. Like I said, for me right now, I don't want to get involved in any of these big themes that we're seeing right now, because I'm a little bit cautious about how many people are suddenly jumping on this bandwagon, but it's not enough for me to fade them, right? For me, I'll just be focusing on those very clear differential plays like the euro sterling from last week. I think that's, in my opinion, the simplest way for a trader like me to approach the markets right now. Obviously, if you've got a different edge, by all means, make sure to use it. But the bottom line is just be careful out there. It's a pretty messy situation. And you don't want to be, giving away your hard-earned gains in a crazy environment like this. If you feel that your edge isn't where it needs to be, then, just take a bit of a breather, reassess your strategy, reassess your risk profile as well. There's no harm in just dropping the risk a little bit. If you feel uncertain or you see things are just not moving the way that they're supposed to. The bottom line is be careful in the week ahead. Also keep in mind, it is a slightly shorter one this week when it comes to Australia. We've got Anzac Day coming up on Friday, so a little bit of a cheeky day off on Friday after the Easter long weekend. That's obviously not for everybody, but definitely for us here in Australia, so looking forward to that. Bottom line is have fun out there, be careful, stay nimble, and trade safe.